Let's start with a review of why federal mortgage laws matter for MLOs. Purpose and scope of federal consumer protection in mortgages. Which federal law primarily aims to ensure that consumers are provided with helpful information about the cost of their mortgage loan and to protect them from unfair practices? Is it A, Equal Credit Opportunity Act, B, Home Mortgage Disclosure Act, C, Real Estate Settlement Procedures Act, or D, Fair Housing Act? The answer is C, Real Estate Settlement Procedures Act. Why this question may seem a bit tricky, the Real Estate Settlement Procedures Act and the Truth in Lending Act both provide consumer protections, but RESPA specifically focuses on settlement costs and practices. How much of the MLO exam covers federal mortgage laws and regulatory structure? What percentage of the MLO exam is typically dedicated to federal mortgage laws and regulatory structure? Is it A, 10%, B, 23%, C, 50%, or D, 75%? The answer is B, 23%. Why this question may seem a bit tricky, the MLO exam covers a broad range of topics, but federal mortgage laws and regulatory structure are a significant focus, typically comprising about 23% of the exam content.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
RESPA, Regulation X, Essentials. What is RESPA? Purpose, applicability, and covered transactions. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to regulate interest rates on mortgages, B, to ensure consumers receive disclosures about real estate settlement costs, C, to standardize mortgage application forms, or D, to limit the number of lenders in the market? The answer is B, to ensure consumers receive disclosures about real estate settlement costs. RESPA aims to protect consumers by ensuring they receive disclosures about the costs of real estate settlements and prohibiting certain practices like kickbacks. A homebuyer is purchasing a single-family home with a federally related mortgage loan. Which aspect of the transaction would be covered under RESPA? Is it A, disclosures about settlement costs, B, the interest rate offered by the lender, C, the appraisal process for the home, or D, the buyer's credit score? The answer is A, disclosures about settlement costs. RESPA covers transactions involving federally related mortgage loans, including the requirement for disclosures about settlement costs. Required disclosures under RESPA, good faith estimate, HUD-1, etc., and fees. What is the primary purpose of the good faith estimate under RESPA? Is it A, to finalize the loan terms, B, to provide an estimate of closing costs, C, to determine the borrower's creditworthiness, or D, to disclose the lender's profit margin? The answer is B, to provide an estimate of closing costs. The good faith estimate is designed to provide borrowers with an estimate of the costs associated with a mortgage loan, helping them understand and compare loan offers. A borrower receives a HUD-1 settlement statement and notices a discrepancy in the fees compared to the good faith estimate. What should the borrower do to address this issue? Is it A, ignore the discrepancy as it is common, B, immediately cancel the loan, C, contact the lender for clarification, or D, file a complaint with the CFPB? The answer is C, contact the lender for clarification. The borrower should first review the HUD-1 and GFE to identify specific discrepancies and then contact the lender for clarification or correction.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Prohibited practices and kickbacks/referral fees rules. Under RESPA, which of the following practices is prohibited when it comes to referral fees? Is it A, paying a bonus to an employee for referring a client? B, providing a discount to a client for using a referred service? C, receiving a fee for referring a client to a settlement service provider? Or D, sharing marketing materials with a settlement service provider? The answer is C, receiving a fee for referring a client to a settlement service provider. Why this question may seem a bit tricky, RESPA prohibits any payment or thing of value in exchange for referrals of settlement service business. This includes indirect payments or arrangements that may seem legitimate. TILA Regulation Z Essentials. Truth in lending, purpose, what it requires, APR, finance charge. What is the primary purpose of the Truth in Lending Act? Is it A, to promote informed use of consumer credit by requiring disclosures about terms and costs? B, to regulate interest rates charged by lenders? C, to provide federal insurance for consumer loans? Or D, to enforce penalties for late payments? The answer is A, to promote informed use of consumer credit by requiring disclosures about terms and costs. The primary purpose of TILA is to promote informed use of consumer credit by requiring disclosures about terms and costs. It ensures transparency and helps consumers compare credit offers. A borrower receives a loan estimate that includes an APR of 5% and a finance charge of $2,000. What does the APR represent in this context? Is it A, the interest rate charged on the principal amount? B, the total amount of interest paid over the loan term? C, the annual cost of the loan, including interest and other charges? Or D, the monthly payment amount required by the lender? The answer is C, the annual cost of the loan, including interest and other charges. The APR represents the annual cost of the loan expressed as a percentage, including interest and other charges, providing a comprehensive view of the loan's cost. Required TILA disclosures, APR, payments, total cost, and timing rules. What is the primary purpose of the annual percentage rate disclosure under TILA? Is it A, to disclose the monthly payment amount? B, to provide a comprehensive measure of the total cost of credit? C, to outline the loan's repayment schedule? Or D, to specify the loan's interest rate only? The answer is B, to provide a comprehensive measure of the total cost of credit. The APR disclosure under TILA is designed to provide consumers with a clear understanding of the total cost of borrowing, including interest and fees, to facilitate comparison between different loan offers. A borrower receives a TILA disclosure stating the APR and total payments for a mortgage loan. How does this help the borrower in making a decision? Is it A, it guarantees the lowest interest rate available? B, it ensures the borrower will qualify for the loan? C, it allows the borrower to compare the total cost of different loans? Or D, it provides a detailed breakdown of monthly payments? The answer is C, it allows the borrower to compare the total cost of different loans. The TILA disclosure helps the borrower compare the total cost of different loan offers, including interest and fees, ensuring an informed decision. TILA Special Rules, Rescission, HOEPA, ATR QM, Ability to Repay Qualified Mortgages. Under TILA's special rules, what is the maximum period a borrower has to rescind a loan transaction if the lender fails to provide the required disclosures? Is it A, 3 days, B, 1 year, C, 3 years, or D, 5 years? The answer is C, 3 years. Why this question may seem a bit tricky. Borrowers typically have 3 days to rescind, but if disclosures are not provided, the period extends to 3 years. This extended period is often overlooked. ECOA, Regulation B, and Fair Lending. ECOA, Purpose, Protected Classes, Prohibited Discrimination. What is the primary purpose of the Equal Credit Opportunity Act? Is it A, to prevent discrimination in credit transactions, B, to regulate interest rates on loans, C, to provide financial education to consumers, or D, to oversee all banking operations? The answer is A, to prevent discrimination in credit transactions. The ECOA aims to ensure fair access to credit by prohibiting discrimination based on specific protected classes. It promotes equal opportunity in lending. A lender refuses to extend credit to a qualified applicant because they are over 60 years old. Which ECOA protected class is potentially being violated? Is it A, race, B, gender, C, age, or D, marital status? The answer is C, age. Age is a protected class under ECOA. Discriminating against someone based on their age is prohibited under this regulation. Required notices and appraisal rights under ECOA. Under ECOA, when must a lender provide a copy of the appraisal report to the applicant? Is it A, at the time of application, B, within 30 days of application, C, promptly upon completion or 3 business days before closing, or D, only if the applicant requests it? The answer is C, promptly upon completion or 3 business days before closing. Why this question may seem a bit tricky. The timing of providing the appraisal report can be confusing. ECOA requires lenders to provide a copy of the appraisal report promptly upon completion or 3 business days before closing, whichever is earlier. Integration and other federal laws/rules. TILA-RESPA integrated disclosures. How TILA and RESPA overlap. Which of the following disclosures is required under both TILA and RESPA regulations? Is it A, closing disclosure, B, loan estimate, C, servicing disclosure statement, or D, right to rescind notice? The answer is B, loan estimate. Why this question may seem a bit tricky. TILA and RESPA overlap in the requirement for the loan estimate, which provides key information about the loan terms and costs. Other disclosures are specific to either TILA or RESPA. Other related federal laws and how they tie in. Which federal law requires lenders to provide borrowers with a loan estimate within 3 business days of receiving a mortgage application? Is it A, Home Mortgage Disclosure Act, B, TILA-RESPA Integrated Disclosure Rule, C, Fair Credit Reporting Act, or D, Mortgage Acts and Practices Rule? The answer is B, TILA-RESPA Integrated Disclosure Rule. Why this question may seem a bit tricky. The loan estimate requirement is part of the TILA-RESPA Integrated Disclosure Rule, which combines elements of both TILA and RESPA. It's easy to confuse it with other disclosure requirements.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.